Please subscribe for more videos. Click the bell icon for updates.
What is an accounting equation? The accounting equation is the basis of the double entry accounting system, which states that every entry made on the debit side should have equal and corresponding entry on the credit side as well. It helps to prepare the balance sheet, so it is also known as balance sheet equation. Assets is equal to liabilities plus owner's equity. Assets are the valuable resources owned by the company. Liabilities are the obligations. Owner's equity is the ownership of assets that may have debts or other liabilities attached to them. The liabilities and the equity tell us how the assets are financed. That is, financing through debt is known as liability, whereas financing through issuing the equity shares appears in the shareholders' equity. The equation illustrates that all of a company's resources, that is assets, are provided by the creditors or their owners, that is liability and equity. What are accounting principles? Accounting principles are the guidelines and rules that should be followed while reporting the accounts or the financial data. The Financial Accounting Standard Board, that is FASB, issues a standardized set of accounting principles. For international purpose, the International Accounts Standards Board, that is IASB, issues International Financial Reporting Standards, that is IFRS. The main purpose of these principles is to ensure that all the companies follow certain standards in recognizing, recording, and repeating the economic events and is communicated in a language that is understandable by one business to another. External stakeholder, for example investors, banks, etc., rely on these principles to trust that the company is providing accurate and relevant information in their financial statements. The main principles are 1. Conservatism principle. 2. Consistency principle. 3. Cost principle. 4. Economic entity principle. 5. Full disclosure principle. 6. Going concern principle. 7. Matching principle. 8. Materiality principle. 9. Monetary unit principle. 10. Reliability principle. 11. Revenue recognition principle. 12. Time period principle. What is accounting profit? Accounting profit, also known as bookkeeping profit, it is the net income which is left after deducting the explicit costs from the company's total revenue in accordance with IFRS. Explicit costs are the costs that are easily identified and measured. They are the specific amounts paid in the period, for example, labor costs, which are paid as wages, distribution costs, raw material costs, and other production expenses. Accounting profit is generally reported on a quarterly and annual basis and is used to measure the financial performance of a company. Accounting profits include only explicit costs which are to be paid or the expense that require money to be spent. They rather do not include implicit costs because they haven't been incurred and are theoretical. Accounting profit AP is equal to total revenue minus explicit costs. What are accounts payable? Accounts payable is the amount that should be paid or due to the creditors or suppliers or vendors for the goods or the services received and are not yet paid off. They are shown as liability on the company's balance sheet. Account payable are short-term liabilities relating to the purchase of the goods and services incurred by the business. For example, accounting services, legal services, supplies, and utilities. The sum of all the outstanding amount due to the supplier or the creditor is shown as accounts payable balance on the company's balance sheet. The increase or the decrease in total accounts payable from the prior period is shown on the cash flow statement. Accounts payables are debts that must be paid off within a given period of time to avoid default. The management may choose to pay their outstanding bills close to their due date in order to improve their cash flow.